Virtually everyone who starts trading thinks they're going to be a millionaire. Let me show you one screen which shows you why they're not and what they get wrong. Okay, now let me explain what you can see on screen. You see a simple buy and sell button there. This happens to be Microsoft at the time that I've recorded this or done the screenshot. That's 300 shares, which is a notional value of $102,000 worth of Microsoft stock. In other words, if you bought 300 shares in Microsoft at a price of $342.9, you would own $102,000 worth of Microsoft. Got it? Pretty simple. Now, with most brokers, they will allow you to buy that on margin, which would be a margin of about 4.6 thousand US dollars or 3.6 thousand pounds. Let's just stick to dollars to keep things simple for a second. Okay, so you only paid about 4.6% margin. You paid $4,600 in margin, a deposit, okay, to own $102,000. Now imagine that was a house and you were buying a $102,000 house and you only had to put a deposit down of $4,600 and obviously pay interest on the rest of the loan. That's what margin trading is. Now, why is it then 70 to 80% of people lose money? You'd think, hang on, you never lose money on houses. And this is Microsoft, which some would say is safe as houses. So how could you possibly lose money on that either? And this is where they don't become the millionaires they should have done. Because actually, you did that a few months earlier, you would have doubled your money. You would have made $100,000. Just like that, obviously. If that went, if the price went double, you would have done, you could have got into Microsoft a lot lower. Actually, a lot lower for the last 20 odd years. So for 20 odd years, you've seen this price double, and how come your money's not doubled? The mistake people make is they focus on the margin. They say to themselves, well, I only need to put 4,600 down. Well, here's the problem. That buy price, that price, or take the sell price even, only needs to move a tiny bit lower, and you're going to get a margin call. So your £3,600 or $4,600 sitting in that account will be wiped off and you'll be asked to put more money in. Now, of course, if the price went to zero, you'd be asked to put $102,000 in. Is that likely? Of course not. Let's say the price halved. Well, you'd have to, excluding margin, have about $50,000. Have you got $50,000 sitting in your back pocket? Probably not. Is the price going to halve? Probably not either. But I tell you what it could do. It could drop 10%. If it dropped 10%, you're going to have to find yourself $10,000. You might have it. The problem is, even if you've got it, you're probably going to panic before then, thinking if it's dropped 10%, could it drop 20? What if I've got to find another 10,000? So what causes you to fail is not that you've got a lack of patience, not that you don't believe in the company, not that the company can't go up. What makes you fail is cash flow. You run out of money and a bit of psychology within there. You can't fuel it. Leverage is what causes you to panic, run out of cash flow. And that's actually the reason why hedge funds fail and go bust. It's why financial crises happen. Leverage. People can't meet their margin calls. It's why the banking crisis happened. Anyway, my job is to teach people how to invest and get that money doubled without losing all of that, or if they're trading, to point those mistakes out so they don't make them in the first place and yet they still make the returns, because they're clearly returns to be made. Hope you enjoyed it. Have a look at alpeshpatel.com/links to get more free resources. Thank you very much.